Hello ladies and gentlemen, and welcome back. Well, the squeeze that we thought might be happening over the last couple of weeks continues to occur. And even with bad earnings coming out from Microsoft and Google, we just returned back to a role reversal zone that we'll look at later. But what happens next? What about Apple and Amazon on the Thursday evening of this week? Well, that's going to be an incredible pivotal decision here for markets. But from a technical basis, we also have an inverse head and shoulders. The left shoulder, the head, the right shoulder, and the neckline, which is basically to the head, which is the direction that we think we should be going in, pushes us towards gap fills. Now, just so happens that this is actually also the correct trend line that we've sold off every single time in 2022 so far. But is the market that obvious, or does something else hold the keys? Well, we'll be taking a look at the DAX and the Dow for the first time in a little while, because the Dow Jones is showing us something a little bit different. So the market is rallying, the market is squeezing, and of course it's putting the pain train on many bears out there right now. But let's talk about what's underneath the hood, the data, the macro, and the lead indicators. See you soon, guys. This will be a good one. Welcome back, everybody, to the Daily Show here, where we talk about stocks, commodities, and cryptos. We've got a jam-packed show. We'll go through the news, the macro data, the lead indicators, and of course, the key levels that you should be watching. But let's begin with Alphabet, because it missed on earnings. YouTube revenue shrunk. In fact, it didn't increase. It was expected to increase around 3%. It didn't do so. And the company announced cuts on the headcount growth by the half of Q4. So is this the first sign of bigger companies shrinking their workforce, and in fact, employment starting to go back down and unemployment going back up? We've got some interesting stats to do with the bottoms of markets, and more importantly to do with recessions and how you can possibly tell bottoms in a video that's coming later this week. So make sure you subscribe to that. So we move from Google, which arguably has been doing okay for the last couple of years, but a really bad earnings, one of the worst since 2013, to Microsoft, my favorite stock in the entire market. I've always said that. And the Microsoft revenue growth slowed as well. It was slowing, and it still put up some massive numbers. If you pause the video here, you'll see some big numbers. But overall, it's kind of like the new business was covering for the old business. And you can see that in the numbers over here. So both earnings were lackluster. And what happened after hours? The market fell. In fact, Microsoft was down 6, and I think Google was down around 5 after hours at the time of this recording. The thing was, though, is it's just like the normal market wants to do. It's going to do what it does anyway. The actual squeeze that occurred, the market going up, ran into anticipation of this earnings event. Then we saw it drop back down and take off most of what it gained through the session in after hours. Now, at the time of the recording, we're seeing some bounces around that zone. We'll talk about both the bull and the bear case scenarios very soon. But does this all load up with our seasonality ideas? Well, yes, because we expected October or the middle of October into November to be a strong period of time. In fact, if you look at all the bear market years on record over this period, you'll notice that this is what tends to occur. Now, this year's been an interesting one, but seasonality has played out a few times, especially with our picks around August, and of course the drops from August into September. Now we're looking for that rally that squeezes all of the bears out, and then, of course, hopefully a further short. Some of you will say, no, not hopefully, Tom. We want to be bottoming right here. But I don't know if the bottom has come, which we'll talk about soon. Let's look at some bullish price reversal patterns that we've currently got that support the squeeze. We had a 21-day low close. Now we've got a 21-day high close. Now, when we see these types of things, we get some data stats. And there's quite a lot of data points, which is always good. Are the stats positive or bearish? Well, generally for the next couple of weeks, they're historically bullish. Now, they're almost 70% bullish over the week 1, week 2, and 1 month periods. And this is kind of important because, of course, right now we're hoping for a little bit of a squeeze, followed by that potential gap fill, or even just a potential move a little bit more bullish here into a sell-off. And this kind of supports that theory, at least at this point. Let's have a look here as well at Sp500 reversals from the 252-day low to a 21-day high in under 10 sessions. A little bit less data points. Again, the next 1 week better than a coin flip. 73% of the time, we're bullish after this data. And we do have quite a few of them. Notice the ones that came out in 2008. Notice the ones that came out in 2002, 2003. And in previous very bearish times, we tend to get that little bit of reversal off indications like this. So again, it could really support that idea that we've been looking at, which is a squeeze for now and then potentially a drop a little bit later on. If we look at the most correlated markets, a lot of you guys have seen this, who've been watching the channel for a while. 2007, 2008 kind of calls for a potential drop off coming soon, but the rest of them, all the other correlated markets, basically have bounces around this time. Now, some of these markets actually ended their lows at these points, but predominantly we haven't had the VIX coming with us and a few other indications that we'll look at in a video later this week that shows us usually that the bottom is in on markets, and we haven't had a lot of those this year. Smart money versus dumb money, I'll update this when necessary. We're still not seeing dumb money buying in at the levels that usually you would want to kind of instigate a proper squeeze. If you think about all these previous levels before, we've always had smart money going underneath and dumb money going above. And that's what we're looking for to potentially turn these markets off these serious squeeze events. If it does squeeze to the 4100, my guess would be smart money will be down and dumb money will be above it. So that'll be something we will be looking at, and it could signify an incredibly big turning point. Now, a lot of people don't use breadth and thrust as much as they should. I love to see percentage of S&P 500 stocks going to new lows or not. And what we saw in that last low that gave us an inkling that this squeeze would be here, you can see the data's a little bit old now, but it did work, so we just wanted to really point it through, was that we didn't have as many stocks making new lows. It was only a select few that were pushing the stock market down, and this gave us divergence. Effectively, that's a very good stat. Again, a lot of data points coming out from this, and we're in basically week 2 to week 3 now on these stats. So again, the squeeze was kind of predicted off something like that. It's a very solid indication, and it worked out in this case along with the other stats. Let's talk about bear markets. These are all the bear markets since the 1800s. Pause the video if you're interested in checking out that. And then let's go into earnings. So we're at a 68% beat rate, 254 beats, 118 misses. Is this in line with a standard earnings season? Usually we probably come out a little bit higher. I would say 70% plus at this time of the year, or this time in the earnings season is general. So we are kind of not beating expectations by as much as we should be. We've now seen Microsoft and Alphabet, both of them not living up to expectations, both of them pushing that market down. We've also seen Meta. Well, we're not seeing Meta yet, but we've seen Meta make incredible lows off many years. That's coming after the close now. Will it live up to expectations? It's burning cash out of control. I don't know if it's going to do so well, but the expectations are shocking for it anyway, so we'll find out what happens there. And the big key ones, I believe, are here. And this is Shopify, Apple, and Amazon. Basically, the consumer discretionary components of the market. That's XLY. Do we see demand destruction through these particular stocks? And if we do, is that a good positive thing for the markets? Does that mean that the interest rates potentially won't have to be hiked as much by the Federal Reserve? Something that we're certainly looking at. When we take a look at the nature of the market in the last 24 hours, it's a big deal. We had two of the most crazy sectors, PBW, clean energy, and solar, coming out ripping through the session, 6.5% and 4.8%. It was the day of hyper stocks. It was the day of crazy growth stocks, and the market wanted to buy everything that was crazy. This is the right type of thing that we usually see associated with squeezes, or at least with recoveries. The reason? It was growth. It wasn't defensive. Remember the previous session, if you watched our previous video, we talked about consumer staples and healthcare being the two that we saw bounce. This is not what we had in the session. They were some of the least performing sectors before, after the hours. The other thing that we want to always remember is that, is this in line with some of the correlations that we've seen from 2006 and 2009? I've been reading the comments, and a lot of people are saying, why are you even comparing these periods? They're totally different. It's just a very interesting stat. And again, it's kind of in line with something that's very interesting here. Back then, we had a lot of VIXs going to 35. That's what we've seen in 2022. We haven't seen that max fear capitulation. And when you overlay them and we're kind of moving down like we are right now, we're basically here, realistically, in terms of the VIX going down. Just around the corner, there was an incredible spike in fear, and that's usually close to those lows when you see a fear go that high. So that could be a very interesting point moving forward. Well, just before we get into the charts and we have a look at the key levels that we should be watching right now, I'd like to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now here we've brought up a heat map of the last 10 days of the biggest 50 market cap stocks within the Sp500, within the US market. And what you'll notice is it's actually across the board green. But some greens are better than others. Imagine if you were in semiconductor equipment or movies and entertainment or even hotels over the last 10 days. You would have done better than the market itself. Now you can figure this out by looking at this particular platform and of course figuring out what's having a run on the day. Following the sector can be incredibly important. At the time of this recording, there's been quite a few sectors that outperformed the market in the last 24 hours. But if you were in the wrong one, you just didn't do as well. Following market flow is super important. Now, another thing during this earnings season is, of course, you'll need access to a calendar. Tiger Brokers has you covered there. You can select anything you really want, and you can even select your watch list. So if you wish to only see your watch list and the earnings reports coming out from that, you can do it. You can select here report announcements, and you'll notice I've made a little watch list of some of my favorite stocks for this week. Alphabet, Microsoft, Apple, Amazon, all these types of things. And of course, we want to have those in our platform as much as possible and be recognizing when they're coming out. Do also remember that Tiger Brokers has its own custom platform as well, where you can select your own windows, have level 1, level 2 data, all these types of things within the platform. So if you're interested in checking out Tiger Brokers, there's a special offer for especially our Australian and New Zealand audiences. You get, instead of 40 zip stock, 60 zip stock until October 31st, as long as you sign up and open an account with 1 cent or more, I believe. Check out the T's and C's. For everyone else around the world, if you're interested in the platform, why not check out Tiger Brokers? There's a whole bunch of other features there that we've talked about on this channel. And of course, some of them might be right for you. So let's now jump into the charts and take a look at the key lead indicators that we're seeing throughout the charts right now. This is one that I always like to have on my chart. S&P 500 stocks above the 50-day moving average. We're seeing that ramp. We're not at pure squeeze levels yet, which I'm kind of estimating could be above this 60 line, but this is certainly something that I think we should be paying attention to and possibly correlate it with our stock market information later on. What about the VIX? Well, the VIX is dropping. It actually made a new low and got underneath this previous low over here, coming off again this 35. Now, if we looked at that previous VIX overlay, that's kind of pointing towards a potential decline, kind of like this, and then a huge spike in the VIX. Let's take a look at the weekly here when we scroll back over to 2008, and you'll see again, here was that last time the VIX came up, it dropped off, went down, or everything was all cool, and then it certainly wasn't cool, and it went explosive, the watershed moment on the market at that period of time. Will it be something similar this time round? It could be, and we have to be open to that, especially as this market squeezes higher. So what types of indications can we see if the market's going higher? Well, one, we want to see yields drop. If yields get underneath these kind of low zones, then that kind of points towards a tick box for the S&P 500 to go higher. We saw it come right down. It actually went underneath this low, but it didn't quite break through on the 2-year and it bounced back up. So we're still looking at a fairly high overall yield. Now, some people will say, is this a head and shoulders, Tom? Left shoulder, head, right shoulder? Certainly could be. I don't really so much TA these charts. What I'm looking for more is just a slow, gradual decline in trend. Remember, if you put the S&P 500 over yields, what you'll notice is that when the yields go even sideways a little bit, the stock market can recover. When the yields are going up, stocks will tend to go down. So that's something that we need to be very, very aware of. The US 10-year also still very, very high, though it has been decreasing in the last couple of days. Maybe that's a good sign for this squeeze to continue for now. Let's take a look at some other things that are looking a little bit more positive. High yield bonds. Corp bonds have been kind of a precursor in 2022 between the market making kind of a new high and this bond market not doing so. Now, when that happened and we've seen these series of lower highs, it's generally shown us that the market is squeezing and ready to turn back around. Well, high yield bonds had a good session, and if they continue to have good sessions with them until high yield bonds start to drop back off and the stock market hovers or goes up, we don't really see that kind of divergence of both ideas. It's the same with corporate bonds. Both were doing okay through the sessions. If we move over to TLT, a little bit of a bounce here due to the yields actually declining slightly. And it's not quite at that 90 zone yet for TLT, but a lot of people want this. Why did it bounce off this zone? Oh, look, it just probably got into the structure that goes through here. But yeah, TLT incredibly low. And for some longer term investors, I'm sure they're looking at this going, wow, is this like a great investment or not? Well, time will tell, but certainly treasuries in America are one of the better treasuries to be looking at. Let's take a look at DXY. Did it do what we wanted it to? Frankly, yes, it did. It did a massive turnaround, bang, shorted straight into our demand zone. And at the time of recording, it's finding some demand. It's finding some buyers. Now, could it rally and then drop off? Absolutely. What we're looking for now, though, is continued weakness for the dollar. Basically, if the dollar does return back up to this point now, you would expect it to be a supply zone. The market should find issues with this area. That was a very aggressive sell-off on the dollar, but it was exactly what we wanted for gold, for euro, and for a few things that we'll talk about soon. At this stage, we're in a demand. For some buyers, they're going to look for potential buys, then potential sells. I could see it even correlate or just sit here for a bit and then potentially drop off. Next level is 110.25, and then underneath that, we've got 109.50 and the 108.20 zone. These are the levels that you'll be looking for. The deeper the US dollar goes, the more likely the stock market is to squeeze and push higher. So watch this point, and at this stage, it is looking relatively weak on most timeframes. Let's move over to gold. So what happened with gold? Well, gold actually ended up coming right down to the area that we hoped it did. And if you're part of our private community, which you can join 7-day free trial over at fxevolution.com, website in the watermark down here, then you would know that this was one that we were certainly looking at yesterday from a technical perspective. And we did see a nice bounce in here, and it just ripped, and it had a massive gain. That was probably the best correlation along with the euro for the DXY. At the moment, we're going down. We're kind of holding above this previous resistance zone, and we're finding some initial buyers. This is a fairly nice little kind of thing to see here. A little bit more of a bounce, maybe a pullback, then hopefully continued rally here for gold. Let's have a look at the daily close just to get an idea of what it did. Another nice bounce, but again, just a long leg doji. So a high, a low, an open, and a close, or an open and a close. So overall, we had not really too much decision. The market was fairly happy with where it found. If the DXY goes lower, expect gold to go up. The euro did something very similar. It broke through our first level of supply here, and now it's hovering just underneath this level here. Now, if it does this, and let's say it does more consolidation, in my experience, when markets have consolidated before a high, and then they break out to the upside, they often rip that high. So they take it massively, and then they could be moving towards 1.005. So again, if stock markets do continue to go up, if dollar index continues to weaken, from this perspective, if we break high, there's a good chance the euro will try to rip to that 105, and this will not be actually as big a resistance as some people will think. US oil, yeah, it's just consolidating. Pretty boring on oil. This level that we talked about previously continues to be kind of that short zone, though it didn't have a very strong reaction off it like it has had before. So again, 83 seems to be the buy zone, and 86 seems to be the sell zone. We're stuck in effectively a channel here on oil, and we haven't broken out. We'll report back if we see any big movements there. Let's move over to Tesla. So I guess fortune favors the brave here for Tesla. People that bought the 200 were pretty happy with themselves because it's gone back to 222. As a daily close, this was actually the same close as we saw previously. These little gaps above didn't do anything. So we're kind of stuck in a channel. Again, we're at resistance. The rest of the stock market, if it starts ramping, expect Tesla to, I guess, ramp with it. But I still continue to believe Tesla will probably come back and get that 180 at some point in the future. It just seems likely based on everything we've seen in these stock markets. But for now, I mean, all good, I guess. It's back at resistance. And if the stock market turns to the upside and continues to squeeze, we might be looking at that unfilled gap here at 238 being filled by Tesla relatively soon. Some big stocks that are coming up with earnings. We've got, of course, Amazon. Here's Amazon at the resistance, getting ready for the big Thursday after the close numbers. We'll find out how that ends up doing. Then we've got Apple as well. So you can have a look here at Apple. Again, this one's actually broken out already. So it's taken this high and Apple's just steamrolling, getting ready for the earnings result. Pretty nice. If it does pull back through the sessions, again, this 147 could act as buying pressure. We had resistance here. We had resistance here. This could become support, standard role reversal, potentially some bullishness from Apple. An interesting point over the next couple of hours. Let's move over to the DAX though. The DAX is returning back to a point where we've seen it sell off before. So this is the downward trend line. Now I would estimate that this particular alert would hit, I always estimated around the time that we would hit the SPY at about 38.80. So the DAX is getting close to a turning point. Let's see how that ends up interacting. The UK 100, the FTSE, getting close to that resistance, though not breaking to a new high. So again, not a fully fledged recovery. Now remember what will happen. Well, the DAX might hit the high as the FTSE hits this area. Maybe that's where we see the sell-off occur. But if we breach, then we could be looking for further squeeze. And that could tell you that 4,100 is more possible on the US market. Although it's not the US market, they are correlated together. But where I like the most correlation has to be this Dow. The Dow is just going ham. Look at it go. Everyone wants the Dow. The Dow never made a new low. The Dow has been blitzing it in the last couple of weeks. Volume's been increasing here as it's blitzing it. And we still have an incredibly consistent downward trend line here on the Dow that's picked up all of the previous shorts. So how many more percentage does that give us? Well, it gives us around about 3.6% before we hit this level, before we hit this high and potentially take that kind of swing up here. And this is a very significant chart, well worth watching. The Dow, for the first time in a while, we've got it on the charts. The US 2000, the Russell, nice breakout here, new high formed, break of the downward trend. So that kind of exposes the ability for the smaller cap stocks to potentially have a really nice rally here over the next couple of days. Again, increased volume recently compared to what we had over here, and the squeeze seems to be fairly intact on that particular stock. Let's have a look now at the US 100, the NASDAQ. What's going on here? Well, the NASDAQ's come back down to this previous consolidation zone. Now, pretty much bulls don't want this zone to be taken low. So what that means is, if you're thinking about it, this is consolidation. What's probably going on in here? Trades. So if we have trades that are going on in here, the culmination of those trades was bullish. The demand outstripped the supply. The buyers came back in. The market's now dumped after earnings and it's found buyers right in this level. So it could recover, maybe fill this kind of gap that happened here on this particular future, and then maybe drop off. But realistically, what you don't want is too much new lows. So we'll have to set alerts here for underneath these levels. Now, I'm not going to trust the NASDAQ reading, but what I will do is use the US 500. Here are the key levels that we're looking at. 3880, 3900, previous supply. 39 kind of 40-ish zone. So if you see here, an incredibly sneaky little supply that sits behind this level. Again, we may see turnarounds at these levels. And that would probably coincide with the Dow hitting the downward trend line. But more importantly, we do have the S&P 500, which has been the most accurate one to pick these tops recently. And remember when we used this last time, this downward trend line? A lot of people didn't believe it was possible. It hit it. Now, it could be too obvious this time, and maybe it's the Dow. That's why I've got it up. But yeah, overall, it looks like the squeezes should continue into here unless earnings is going to stuff us all over. So if we get squeezes, these are the kind of levels we want. If we continue to squeeze, we fill the final gap here at 4,100, hit this downward trend line, and potentially there, that's where the fireworks happens. The higher it goes, the faster it goes, the more likely it is to be a false rally, especially if it's speedy. I kind of want to see Speedy Gonzalez. Imagine if it just went bang and went up like 5 to 8% really quickly. This is around 7-ish% to get back to those highs, and it just smashed through. If it did, that's a fairly positive sign that the market has done it on false pretenses, and that's something we will be looking at. It's a really nice bottom here. Most people will be looking at a whole bunch of different things. Some people will just think of it as a breakout kind of pattern. Some people think of it as the inverse head and shoulders. But what I'm again focused in on is these previous lows. You'll notice I have a little demand sitting here. I'm going to set an alert because I don't want to see the market underneath that low. If that happens, we've got a high, a low, a higher high, and then we would see a lower low. Not ideal, kind of like a first time frame change of trend. And then potentially we see rallies met by sell demand. So be very careful here. This is still the possibility of an overall distribution. It still is possible, although at this stage, it's a series of peaks and troughs and higher peaks and higher troughs, etc., etc. There's no real reason to say bearish yet, but if it happens, just like that, you have to flick the switch. It's the way it is. Here's the Sp500, just so you can see the downward trend lines. And of course, we have unfilled gaps throughout these types of zones. So again, if it comes up, it would be magical if it did hit that level. For the options for the week ahead, we can refresh this if we wish to. Let's have a look at the 28th. And we get, let's see what this ends up doing. I'll just refresh that here. And we end up getting, for the 28th, a maximum pain of 375, and we're currently above that. We don't usually use maximum pain in weeks like this. The volume open interest is less, but you can still see there's a lot of puts to expire. Poor people at the 330s, they're going to have sad faces. They definitely lost on their puts. I feel bad for them. Bitcoin moved off the equilibrium and it slammed straight into our previous supplies. This area has been previously shorted many times, but if we take it, pullback should be met by demand. And again, I would expect the stock market to also be ripping to new highs at that point. Let's have a look at what's outlook for the rest of the week. We've got Wednesday here. We have some new home sales for the US. Nothing too important there. We got the rate statement from the Bank of Canada. Then we have monetary policy statement from the Eurozone. That will be important. Advanced GDP, don't care. And then we've got basically a bit of the ECB press conference. Now, I don't know how much this is going to affect everything, but generally speaking, that's the secondary biggest central bank you need to pay attention to. So it's a big one. Then we have monetary policy statement from Bank of Japan. Yay, fun. A press conference. Again, yay, fun. And then we move into the core PCE price index. So it's still jam-packed at the end of the week. We've got earnings. We've got crazy PCE price index. We've got central banks around the world going wild. And it is still time to be very careful out there. If you enjoyed today's video, remember to subscribe and smash that like button. And guys, as well, if you're from Australia or New Zealand, remember until October 31st, there's a special offer from Tiger Brokers where you can get, instead of 40 zip stock, which already was special for FX Evolution community members, you can get 60 zip stocks. For everyone else around the world, if you're interested in the platform, of course, click the links in the description down below. But until October 31st, if you sign up, and I believe you fund with over 1 cent or more, you'll be eligible for 60 free zip stocks.